Welcome back to Finance Bros, navigating risks and riches in Singapore. In today's episode, we'll discuss about the importance of diversification and asset allocation in your investment portfolio. Let's explore strategies to optimize your wealth accumulation through effective diversification and asset allocation. So the first thing about understanding diversification is what it really is all about, is that we have to understand what's the definition. So put out by Investopedia, it says it's owning a wide variety of investments with different characteristics to reduce the volatility. So it basically just means you're spreading investment across different asset classes, industries, and also geographical locations to reduce your risk. And the benefits that comes associated with it is that it can help mitigate the impact of market volatility and specific risks associated with individual investments. I think this thing can be pretty much seen in the last couple of years, where you can see at the start of the pandemic period, I guess the only industry that was doing extremely well was the tech industry.
Right, that's right.
Yeah, because everybody was all going to be home-based and a lot of people has a lot of tech reliant. And shortly after, the same industry we're talking about also went to a very steep drop.
Yeah, got affected the most.
Very steep, yeah. So that is just to show that if you had diversification in place, entirely not just investing in...
And then currently what we are talking on that same industry, it has picked up incredibly well again.
The most also. So this is how you should really think about diversification as a strategy. Yeah, so perhaps Simon can share with us.
Yes, definitely. So some of the strategies that people use for effective diversification, that you can use it as well. Okay. The first of all, of course, is asset class. This diagram you see here is a very colorful diagram. It's across different asset class, such as stocks, bonds, real estate, commodities, in which the stocks, there's also large caps, small caps, S&P 500, and so many different other things, all right? Maybe just let me explain how do you look at it, okay? On the top, in the diagram, you see that if the asset class performed the best at that year, it will be on the top. And of course, if the asset class performed the worst, it will be at the bottom. So in 1995, example, 1995, the large value stocks performed the best with the growth of 38.36%, whereas international stocks performed the worst at 11.21%. And of course, this data has shown is from 1995 all the way to 2014. And I believe that if you want to pull out data from 2014 all the way to 2024, it is also a very different color. So what do we actually decipher from this diagram, right, is that different asset class perform well at different stage, okay, at different year. And if you have a very diversified portfolio, then you will be probably you can weather all the storms in the market, right? So what you can see here, the research have shown that there's no asset class stays on top for the longest time. Okay, if you see all the different colors, it means no one color stays for too long. Okay. Secondly, of course, equity gives the highest return, whether it's small cap, large cap, S&P 500. It will give you the highest returns. And the third one is, of course, real estate also performing well. Okay. But it's only topping the list for 5 of the 20 years. All right. And commodities is extremely volatile. Right? Commodities such as gold prices, silver prices, all that's considered commodities, right? So they give the highest annual returns for 4 out of 20 years and the lowest returns for 7 years. Bonds don't give higher overall returns, but it's a very stable investment. The asset class has only 2 negative years out of 20, so it makes a very good buffer, I guess, right? They did the best in 2018 when all the stocks market are crashing. So it's the 2018 is the financial crisis. S&P 500 gives solid overall returns. The index was only negative for only 4 years, and that's during the dot-com bubble and also the 2008 recession. And so in the studies, it also hypothetical says that in terms of allocation wise, this is based on different risk appetite and what you want. All right, it's 40% bonds, 50% on large cap growth stocks, 50% on large cap value stocks, and 10% international stocks, 5% small cap, 5% small cap growth stocks, 5% REITs, and 5% commodities, just to diversify away all the risks and reduce volatility. Okay, basically, it seems very complicated. It means that just don't put all the eggs in one basket. Okay, and we want to talk about more on industry sector. Okay, so how do we spread and diversify across different industry sector? So just to understand what is different sectors all about, there are a total of 11 different sectors: energy, material, industries, consumer discretionary, consumer staples, healthcare, financials, infotech, telecommunication services, utility, and real estates. So that are all the 11s. So diversifying across sectors can mitigate unsystematic risks caused by factors specific to the individual industry or companies within an industry. So some examples that we can see right now is in a high interest rate environment. Okay, it's very bad for the REITs. So basically REITs need to borrow money, right? Because it's the property market, right? So because of high interest rate, their cost of borrowing gets higher and that reduces their profit. But on the other hand, a financial sector such as banks, it works perfectly for them. So if let's say they are charging higher interest rate, which means that they're earning more money at current state. So if let's say you have these two different sectors in your portfolio, one is real estate and one is financial, then you have a good balance of both of them. If you focus just solely on REITs, then it will perform badly at current stage. Geographical region, okay, so we can diversify across geographical as well. We just want to know, okay, so this is an example, regional allocation you can see. So there's Americas at 63%, which is in red color. There's Asia, there's Europe, there's different places. This is just so that you can diversify away from all the risks that are happening in the country itself. Okay, just for example, like the tech crackdown in China, okay, the market has not picked up even up to today's. So if you only have a portfolio that focuses on all the China stocks, then your portfolio will be quite bad. Based on the Hang Seng Index, the portfolio should drop by about 40%. So whereas if you only have 100% in US market, such as like S&P index, right, your portfolio probably has increased by 81% over the 5 years. If you mix these two portfolios together, then of course your risk is diversified away. Okay? And maybe we can pass to Jimmy to talk more about the asset allocation.
Yeah. So the third segment we want to talk about is this thing called asset allocation. It is the key component of building a diversified portfolio. And so let's really look at what do we mean by diversifying. Basically, it is to determine the optimum mix of asset classes based on our investment goals, risk tolerance, and time horizon. So there's this table that we put out the comparison for you guys to take a look at it. So there's basically 3 different kinds of asset allocation strategies. The first one is strategic asset allocation. Basically, it means it's a long-term approach to portfolio construction that involves setting a target allocations for various asset class based on the investor's risk tolerance, investment goals, and time horizon. And its main characteristic, right, is to actually provide a balance between risk and return over the long term, and typically involves periodic rebalancing and maintain the desired asset mix. And of course, the benefits that's associated with it is that it provides a very disciplined framework for investing and helps investors to stay focused on the long-term goals despite the short-term market fluctuations. So in a very unsteady economic time, a lot of people will find it very hard to stick to their investment principle. And this is exactly why having a strategic asset allocation gives you a very clear guideline so that you don't steer just because you hear a lot of market unrest, a lot of news out there. Yeah. The second thing is what we call tactical asset allocation. It's basically involving deviating from a strategic asset allocation based on a short-term market forecast or changes in economic conditions. It is a more active approach to portfolio management compared to the strategic one, and it seeks to capitalize on short-term market opportunities. And of course, the benefit is that you can obviously potentially enhance your return by taking advantage of the market inefficiencies or avoiding the downturns. But this will require a lot of skills and expertise to execute successfully. And the last but not least is this thing called dynamic asset allocation. Dynamic asset allocation is a strategy that adjusts the allocation of assets in a portfolio based on the changing market conditions or economic indicators. It aims to capitalize on market trends or economic cycles by shifting allocations to asset classes that are expected to perform well in a current environment. Of course, the benefit will be providing a flexibility to adapt to the changing market condition, and it can potentially improve risk-adjusted returns by reducing exposure to the underperforming assets. So these are the considerations. Ultimately, for risk management, right, all asset allocation strategies are aimed to manage risk, but they do so in different ways. Strategic allocation focus on long-term risk-return characteristics, while tactical and dynamic allocation may seek to manage short-term risks or capitalize on market opportunities. And of course, you obviously have the most controversial, discussed topic, which is whether it's active or passive management. Tactical and dynamic asset allocation requires a more active management approach compared to strategic allocation, which can have implications for cost and performance. And the other thing will be the investor's preference. The choice of asset allocation strategy should align with our own preferences and risk tolerance and investment goals, more importantly. So, in conclusion, asset allocation is a key determinant of investment success, and different strategies offer varying approaches to achieving optimal asset allocation. By understanding the characteristics and considerations of each strategy, investors can make informed decisions to build a portfolio that aligns with their financial objectives and risk tolerance.
Right. I think the most important part, which is this segment 4, is the importance of regularly review and rebalancing your portfolio.
Yeah.
I think if let's say you ask me to do all the things above, right, it's quite difficult because I still have my own job to do, and then at night I'm so tired, I make my girl sleep, and then I still need to look at the market and do so many homework, thinking of where to put in, whether is it US, whether is it China, whether is it Africa, whether is it India. I think it's too much of a work. So I think to speak to a financial advisor, a professional one, I think it will be good, and regularly review it. Okay, we realize that different age group has different objective and investment strategies. So if you are very young, like previously when I just graduated from school, right, I only think about what's the fastest way I can make money. Right, I have big dreams, big goals, and this and that.
Yep.
And once I get married, I start to have a different view in my life. Right, I would think that I need to be alive and I need to earn a decent income so that I can sustain the lifestyle that I'm having, and retirement starts to play an important role in my life. And of course, when I grow a little bit, maybe 10 years later, I will view things differently. I will see the world differently as well. So having said that, different life stage, different point in time, we should have a review and talk to our financial advisor. Just let them know what is the expected return that we are expecting. I think this is something that is not clearly really spoke about. I think Jimmy shared a very important point with me that usually people just put all the money in S&P 500. They expect a certain percentage, but what is the percentage that is much needed? Do you really talk to your financial advisor about that?
Yeah, having 10% return, 8% return, 6% return is quite irrelevant if you don't really know what you are investing for. I think one of the key things, a lot of financial advisors, or at least qualified ones, what they do is really to help you determine, like in your timeline, life stages, what do you really invest for? What is the amount you need to look out for, and what is the rate of return you should be expecting? From rate of return, then you work backward, reverse engineer, and look at what kind of asset classes can get you there. And then of course, everything that we just discussed in this episode will come in play.
Right. Yeah. So I think reviewing the process and at each different timeline, I think is the most important. And of course, rebalancing as well. So maybe you're holding too much bonds when you're still young. I mean, you don't need that bonds, that safety net, right? You can more equity base and this and that. So I think the concept of rebalancing is also very important. And just to target into each asset allocation. Yeah.
So, in conclusion, diversification and asset allocation are essential strategies for managing risks and optimizing returns in your investment portfolio. So join us next time as we continue our exploration of wealth building strategies. Until then, keep striving for your financial goals. This is Jimmy and Simon signing off.